If you're considering making an investment in the stock market, there are some important things you should consider doing before you start the process. Buying individual stocks can be very risky, especially to the novice investor. So you'll want to prepare yourself as best as you can before making your first purchase. To help, we've put together a list to get you started. So before diving into the stock market, here's a list of the top 5 things you should do before buying your first stock. Starting with number 5. Pay off any high-interest debt first. If you have any debt with high interest rates, such as credit cards, you'll want to pay down as much of that debt as you can. Having debt with high interest payments is costing you more money than you may realize. And so paying off that debt will immediately start putting money back in your pocket. Let's look at an example. Assume you find a stock that earns 10% per year, and you decide to invest $1,000 into the stock. But at the same time, you also owe $1,000 in credit card debt, costing you 20% per year in interest payments. Though you may earn $100 from your investment in the stock, you lose $200 from owing money on your credit card. And when combined together, you have a total loss of $100, even after earning money from your stock investment. However, if instead of using the $1,000 to buy the stock, you used it to pay off the credit card, it instantly puts $200 per year back into your pocket. Plus, you've not only reduced how much debt you owe and increased how much money you save, but you've reduced your financial stress as well. Number 4. Budget the amount you plan to use for purchasing stocks. There will be moments where you turn on the news, look at your phone, or get on your computer and see that one of the stocks you purchased has declined in price. But as mentioned earlier, buying individual stocks is very risky. You'll probably have moments where you feel some panic, and this is one reason why budgeting the amount you plan to invest is important. It can help reduce some of that anxiety and maybe even take advantage of buying stocks at lower prices. There's no telling where the price of a stock will be in a month, a week, or even tomorrow. You may have to hold the stock for a minimum of 5 years or even longer to see your investment play out. But remember, investing is not a sprint. It's a marathon. You'll want to pace yourself while running the marathon, and budgeting the amount you plan to invest can help you do that. Number 3. Learn how to do fundamental research. Identifying a stock that has the potential to be a good long-term investment takes a lot of homework. Remember, you're not just owning a ticker symbol whose price moves up and down on a computer screen. You own a share in the business, and you should view the investment from the perspective of a business owner. That's where fundamental analysis comes in. Understanding the fundamentals of the company is vital to determining if their stock is worth buying. You should ask questions like, what products and services do they provide? How competitive is their industry? Do they have a track record of being profitable? And if they are profitable, how much am I paying for the profits they earn? But perhaps most importantly, you'll need to be able to evaluate the company's financial statements. These include the balance sheet, income statement, and the cash flow statement. Learning how to read these 3 statements will help you evaluate the financial strength of the company, performance trends, and much more. Being able to understand these 3 financial statements and what they say about a company is crucial to doing thorough research and evaluating the financial health of a company. Number 2. Consider buying index funds instead of individual stocks. As you can probably tell, doing fundamental research can be very complicated and time-consuming. It takes a lot of knowledge and skill to do it properly. But of course, there's never a guarantee that a stock you pick will be a winning stock. There's always the possibility that you could still be wrong about the future of the company if you decide to buy shares. That's why you want to diversify your investments and spread your money out across multiple stocks. But that means spending more time doing even more research. This is where index funds can be a great option, especially for someone who is new to purchasing stocks. If you're not familiar with index funds, here's a quick breakdown. An index is a collection of financial securities like stocks or even bonds that meet certain criteria. And an index fund is an investment that essentially copies and pastes a specific index into a financial security you can purchase, like a mutual fund. You could think of it like buying a basket full of stocks. So, if you're just getting started with investing in the stock market, index funds are a great option. Number 1. Set aside 3 to 6 months of expenses in a savings account. Yes, it does seem a bit counterintuitive that the number one item on a list that prepares you for investing is first having money set aside that is not used for investing. But like we mentioned before, investing is a long process that spans multiple years. Having 3 to 6 months of expenses saved is something you should do regardless of whether you buy stocks. But if you are going to invest in the stock market, having the money in cash to cover those expenses will help you handle any price volatility over time. And always remember that it's never a question of, am I going to have unexpected expenses while investing? Life is full of surprises. And when emergencies happen, you want to make sure you have the money set aside to handle those emergencies without having to touch your investments. Otherwise, you may be forced to sell a stock you purchased before you planned. And if the stock price has declined since you first purchased it, you may even be forced to sell that stock at a loss. To make the situation worse, the stock price may turn around and start to increase again shortly after you sold it. Which means, if you didn't have to sell the stock to get the money so you could pay for some unexpected emergency, you could have waited for the stock price to go back up again and not had to sell it for a loss to cover those expenses. Having plenty of cash and reserves helps to prevent that from happening. It keeps you from having to sell your investments because you didn't already have enough money in savings to handle an unwanted surprise. Everyone knows that life can throw you a curveball. Even if you decide not to invest in stocks, don't wait for a storm to show up and then decide to prepare. Instead, always prepare for a storm before it hits. Investing in the stock market can be rewarding, but can also be damaging if not done carefully. We hope this list will give you a better chance at success. And always consider talking to a qualified investment professional before investing. If you found this video helpful, feel free to share it with a friend and be sure to like and subscribe. Thanks for watching. And remember to invest wisely.